Good morning, everybody. I am delighted to welcome you to Aviva's Capital Markets Day. Both all of those of you here in the room and the many of you who are viewing online. In a moment, we'll show you a brief film. It captures what Aviva is here for. We are here, quite simply, for our customers, all our customers. We are here to serve them brilliantly, today and tomorrow. And by delivering on our purpose and on our strategy, we will create enduring value for our shareholders. There is much to do to improve customer experience, to enhance our cost efficiency, and to optimize our investments for the future. Maurice has made a great start, and all of us, board and management alike, know that improving the performance of the business is the first essential task. Beyond that, we must define and execute a strategy to optimize the long-term value of the group for our shareholders. The strategy that Maurice will be putting in front of you in a few minutes, the board and I agree, will both inspire our people and put Aviva on a trajectory to realize all the promise of its wonderful franchise. So, first the film, and then it will be Maurice. Thank you very much.
Life's complicated. Things don't always go to plan. It can be hard to know what to do for the best. We understand that everyone needs someone to rely on.
I'm going to do everything in my power to help you today.
Thank you.
A helping hand in an uncertain world. We're with people when it really matters, to help them make the most of life. We understand what's important to our customers and take pride in doing things well, using our expertise and empathy.
So if you want, you can always just give me a call back at any point.
We care about people, about bringing them peace of mind.
Service from Aviva has been amazing, so thank you very much indeed.
And helping them build a prosperous future. We're part of a family, employees, distributors, partners, and customers.
Grazie Patrizia, grazie davvero.
We keep our promises.
They took care of my family like they were their own.
We put things right when they go wrong, so our customers don't have to worry about the bumps in the road. We've been taking care of people for over 300 years. We live in the same streets, work in the same towns. We're invested in our people, our communities.
You got your funding?
Our customers, our planet, our home. By looking out for each other, by being part of something bigger.
History has shown us that at best, humans can achieve astonishing things. Today we must get our best again, and it's time for us to all step up now.
We're creating a future we all want to live in. And leaving a legacy we can all be proud of. Because at Aviva, we understand that what you do today creates what's possible tomorrow. With you today for a better tomorrow.
Morning. Every time I see that video, it reminds me of three things. The absolute privilege that I have to work at this great company and spent the last almost 28 years there now. It reminds me of our purpose and kind of what we do all around the world, and it certainly gives me goosebumps. And I think, lastly, it kind of reminds me my hairline's certainly moved in those last 28 years when I see myself at the UN. Morning, ladies and gentlemen. Today is all about providing you with far greater clarity. Clarity about what we are and what we need to do. Clarity about our group portfolio. Clarity about our ambitions, our commitments, and what we'll deliver for our shareholders. And you know what? Clarity starts with transparency. So let's talk about Aviva's strategy, our operating structure, and our ambition. You know, I said in August that I'd be leaving no stone unturned in reviewing the group. Together with the board and my senior team, we've completed a thorough review through the lens of shareholder value. The main conclusion, our performance needs to be better across the piece. We have great businesses, but they're currently not reaching what I believe is their full potential in shareholder returns. And that's what I'm committed to delivering. There is significant upside in getting this right. It's early days for me and the team, but we're already making good progress on this front. Our businesses have competitive advantage in their respective markets. They benefit from Aviva's strengths, our capital, our brand, our technical capabilities, and their focus on helping customers prepare for a better future. I know some of you have suggested different approaches. However, I believe the best thing we can do to maximize long-term shareholder value is to deliver better results at Aviva. I'm dialing up accountability around commercial rigor. I'm insisting on strong, robust business plans where we allocate capital using an economic lens. And that's the focus of today's presentations. Now, those of you that have met me before, you know that accountability is one area where I will simply not compromise. And I hold myself and my team to that very same standard. I expect a commitment to deliver on promises and providing an honest appraisal of our progress. As you know, I've separated our general insurance business and our life business here in the UK. I've integrated our UK digital business back into our main business. This will improve focus, accountability, and performance. I'm already starting to see early benefits, such as enhanced efficiency. And today I'm announcing the creation of our investment, savings, and retirement business. This is a business with unique capabilities that can meet important customer needs and offers Aviva excellent growth potential. I'll talk more about our plans here later. In August, we announced a strategic review of Asia. The review, including seeking offers for our Singaporean business and comparing those offers to the value the business can create as being part of Aviva. The reality is others were not able to offer us more value than we can create ourselves. And hence we made the decision to retain Singapore. Together with our Chinese COFCO partnership, Singapore and China will provide a profitable, growing, and cash-generative presence for us in what are attractive markets. I'm also pleased that my leadership team is now largely in place. We have one of the strongest leadership teams in the sector, a strong blend of experience from both inside and outside the business. I look forward to welcoming Erica Arnold, our new Chief Operating Officer, Jan-Henrik Erasmus, our new Chief Risk Officer, and Danny Harmer, our new Chief People Officer in Q1 of 2020. Let's turn to costs. Reducing costs is another of our commitments, and I'm incredibly pleased to say we're making good progress since we last spoke some 3 months ago. We've increased our expectation of in-year savings to £60 million as a result of progress on both the Lean Group Center and rationalizing our IT. With the initiatives we're implementing, we already have in place £150 million of in-year savings for 2020. And to hit our target of £300 million net of inflation, naturally, we're going after more. Efficiency is no longer optional at Aviva. Gone is also excess costs below the line. Let's talk a bit about strategy. I want to shift my focus back to the group as a whole, starting with our strategy and our priorities. We have refined our purpose, vision, and strategy. This provides our employees with a North Star around which all of our actions and decisions are based. It makes it clear to our customers and our shareholders and other stakeholders what we stand for. We help to create a better tomorrow by helping our customers to save for the future, navigate retirement, and ensure what matters most to them, their health, their families, and their belongings. This means a relentless focus on getting the fundamentals right and delivering on all of our promises. It's what our 30,000 colleagues are aligned behind, and it's what they're focused on in each and every one of our businesses. You know, in today's world, a great reason for existing is only as useful as your broader social agenda. You know, at Aviva, we've been a leader in ESG for over 40 years. Many are now jumping on the social bandwagon. At Aviva, we've been influencing the social agenda, investing with sustainability in mind, and lowering our footprint for some time now. We too are accelerating our efforts. Responsibility in doing the right thing for our customers, the planet, and the communities we work in is at the heart of our values. It makes good business sense, and it matters to our customers, the fact that we're using active stewardship in our voting, the fact that we were one of the few companies that actually helped shape the TCFD rules, or the fact that we've been carbon neutral since 2006, long before, it was the flavor du jour. We will continue to make positive changes, continue to act as good stewards of both our policyholder and shareholder funds. Our strategic priorities, we're focused on 3. Deliver great customer outcomes, excel at the fundamentals of insurance, invest in sustainable growth. Now, there's naturally a link between these priorities. We have to offer simplicity and great service for our customers and our distributors. To do that, we need to be efficient, make good underwriting and pricing decisions, and we must invest to sustain the leadership positions we hold and build on our capabilities. In fact, our business plans and our targets are net of £1.3 billion of investment we're making in the coming 3 years. And as I mentioned right at the start, our people are going to be held to account for spending, for commercial returns, and delivery for our customers. And of course, that kind of accountability includes and starts with me. The evidence shows on this chart that when we get this right, we can demonstrate growth at Aviva. On the slide, I've outlined 4 examples that all fit within our strategic priorities. So first one, Quote Me Happy. It's our UK aggregator brand. We established this business only in 2011. It was a low-cost digital insurer. Since then, we've grown the business to 1.4 million customers. We're operating at a 5% expense ratio, and the profitability has been attractive. I plan to export that kind of capability to other parts of the group. Our UK savings business. We've maintained a leading position in workplace pensions and invested to scale up our advisor platform. As a result, we've increased assets under administration by 58% just since the start of 2016. Bulk purchase annuities. Again, we've invested in capability that enables us to write larger case sizes, and we've leveraged our expertise in illiquid assets from Aviva Investors. We've built a competitive, profitable business with clear hurdles on IRR and cash flows, which this year is expected to write $4 billion in volume. Our Singaporean franchise. Our investment in building the strongest financial advisory network ahead of the market offers customers more choice, better service, and this has helped us deliver consistently new business growth in excess of 20% per annum. Our V&B in Singapore has a credible track record of turning into cash. In conclusion, what this shows is that when we get the basics right, we can perform incredibly well, and we can grow profitably. listen, to bring this strategy to life, I want to take a closer look at our simplified operating model and also our business priorities. We're focused on 5 business divisions, and you'll see all the business leaders present today. This is really how you should think of Aviva going forward. Our financial targets are value-orientated. They are fully aligned to our focus on sustainable, growing returns for our shareholders. We have 5 key objectives at the group level. Solvency II, return on equity, where we target a 12% or greater number. Cumulative group OCG. Cumulative cash inflows to the center, we're targeting between 8.5 and 9 billion sterling between 2019 and 2022. Our cost reduction target and our debt reduction target. To deliver these targets, we're going to need to execute well, allocating capital in the right way, improving our efficiency, and making the right choices on product, mix, and pricing. Let's now turn to the business units to bring the execution story more to life. First of all, the equity story. Our pitch to investors is simple and clear. We will deliver sustainable growing returns. We'll do this through operational excellence and commercial rigor across all 5 of our operating divisions. And the divisions will benefit from the clarity and discipline of being run as separate businesses. A simple structure is important in facilitating better performance, but it also makes Aviva easier for you to understand and gives you greater clarity on how we are doing. Historically, I know our story hasn't always been easy, and we've not made it easy for you to assess our performance, our growth, or our dividend sustainability. So we're changing, providing a structure that's more coherent. And Jason will discuss in his presentation that we're emphasizing economic targets, as these will ultimately be used to allocate capital and ultimately determine the trajectory of our dividend. You know, one of the great things about Aviva is the attractive balance between cash generators and growth engines. You know, our business gives us the ability to sustain our dividend today and grow it into the future. An important point for you to take away, from this chart is that I expect all of our divisions to deliver both cash flow and growth. Just the proportions will be slightly different. I like having this balance as it gives me choices in capital and resource allocation to ultimately drive the highest returns. And we will continue to make choices based on what we believe maximizes long-term value for our shareholders. Let's look at a new division. We have a new division called Investment, Savings, and Retirement, which we see as a long-term growth engine. This division will report into Ewan Monroe. It includes Aviva Investors and our UK savings business. We are focused on creating a modern, integrated wealth and asset management business. I'm incredibly excited about this new business. It will serve a critical growing market which is emerging as consumers look to save for their futures, safeguard against the unknown, realize their hopes and dreams, and importantly, enjoy income in their retirement years. Aviva is uniquely positioned. We have the #1 market-leading brand. We're #1 in workplace pensions. We are rapidly ascending the IFA league table, and we have a growing direct offer, and importantly, the widest range of products and services in the market. This is a market where Aviva should be the clear winner. It's a business where we already have scale. And crucially, we already are the leader in the corporate channel, which gives us access to 3.5 million customers. And we have a rapidly increasing presence both in the advisor and the retail channel. We are setting an ambitious target of 20 billion in net flows per annum across our third-party asset management business and our workplace and platform business. Ewan will provide more color this afternoon. Our UK life business incorporates 3 segments: annuities and equity release, protection and health, and heritage. This business is our cash flow machine. The mandate for UK life is twofold. 1, to generate significant levels of capital and cash flow to fund the group dividend. In fact, our target is between 4.25 and 4.75 billion between 2019 and 2022. And two, to recycle some of that capital into new business to increase replacement cash flows over time. Angela's presentation today will highlight our confidence on increasing cash flows into the future beyond 2022. You know, even if our new business production is flat against 2019 baseline, we estimate we'd increase cash flows from our UK life business over the next 10 years. Now, of course, our ambition is to grow our new business over time. Given our strong fundamentals, I've got plenty of confidence about the outlook for our UK life business. Let's turn to general insurance. General insurance is a £9 billion business at Aviva, and our focus is on delivering profitable growth. I believe we're underweight in general insurance relative to our natural market share, and that's something I want to address. Efficiency, speed, and simplicity will drive personal lines performance. Part of this is integrating digital, which has helped deliver some of the success stories, like I alluded to, such as Quote Me Happy, My Aviva, or the data and analytics capabilities that we've built up, namely in our personal lines engine. We're going to keep that momentum going, but we're also going to focus on the momentum that we have going in commercial lines right now. We have real strength in the SME market, and we're expanding into adjacent areas like mid-market, and that is spurring growth at attractive margins. Our general insurance business has delivered attractive results with low volatility for the past decade. We're also guiding today on even stronger growth of 20%, plus also guiding our combined operating ratio lower. Colin will provide more detail. We're going to maintain the discipline that's allowed us to achieve these results, but we're also increasing our ambition, building scale in Europe, restoring Canada to its rightful place as a market leader, and gathering momentum here in the UK. In Europe, we've achieved strong results in recent years through a focus on the fundamentals: distribution, product mix, and expense efficiency. Our focus is continuing on accelerating our efforts in these critical areas. Listen, the current interest rate environment is challenging. In an environment where 10-year yields are negative, even 0% guarantees create capital headwinds. And this is something that we need to keep managing actively, both in terms of the in-force book, but also in terms of the front book. Our new business mix has been on the right path, with well over half of our life sales in 2018 coming in capital-light products. But given where yields are, our plans to accelerate the business mix optimization. Over recent years, Europe has seen a number of macroeconomic events, but our business has been resilient and continues to deliver. I'm confident that Patrick and the team will ensure that remains the case. Asia. As I mentioned, we've gone through, with a slide ruler, our Asian business. I have considered, with the board, numerous options. This was a thorough process with shareholder value always at the core of the review. I'm really pleased that Nish, our Singaporean CEO, has joined us today to present on the market and the excellent growth potential from our advisory-led business. Retention of China was always a likely outcome, given the scale of the market and our excellent partnership with COFCO and the excellent growth prospects in China. Both countries are expected to pay dividends to the group center in 2019. And in total, Asia now changes from becoming a net contributor of cash flow for the group in 2020 and beyond. Today, we're also announcing that we've reached an agreement with Hill House to exit our Hong Kong joint venture. We're also currently in discussions on the future of our businesses in Vietnam and our joint venture in Indonesia. And I will update you on those conversations in due course. Talk an awful lot about dividend. Our presentations today should leave you in no doubt about Aviva's dividend sustainability. Now, Jason's going to go through our capital and cash numbers in more detail, but on this slide, I wanted to provide a brief snapshot that I think helps sets the tone. Listen, on the left-hand side, if we take a look at the dividend through an ROE lens, the first column, 8%, effectively represents the cost of our 2018 dividend in relation to our Solvency II book value or equity. The second column on the right highlights our group return on equity target for 2022. At this 12% ROE target, we should afford the dividend, but also deliver compounding growth in Solvency II book value. On the right side is the cash flow bridge. This shows that we have the capacity to pay the dividend and reduce our debt in line with our targets. So in conclusion, in conducting my review, shareholder value has certainly been the key watchword. My presentation today summarizes our purpose, our strategy, and our financial targets, and the key priorities that are being built into our execution plan. This should give you a clear sense of who we are and where we're going, and it should also give you an unambiguous message on the dividend, which is sustainable in the current 4-year cycle while still enabling debt reduction and significant investment of £1.3 billion in the business. This investment, together with our plans to improve efficiency, build on the strong fundamentals, will increase the return on equity to 12% and ultimately support a progressive dividend policy well beyond 2022. What I am delivering at Aviva is a company that is simpler, both internally and externally, stronger at operational execution, and better at rewarding our shareholders with sustainable growing returns. Thank you very much. I'm now going to hand over to Jason to take you through the financials.
Thank you, Maurice. Hi, good morning, everybody. As Maurice outlined, our goal is to deliver sustainable, growing returns to shareholders. In my presentation, I'll set out how we'll do this from a financial perspective. There are 4 key points I want you to take away. First, we have robust financial targets focused on delivering economic value. Second, we're generating strong capital and cash flow to fund our progressive dividend. Third, we're investing for the future to grow the company and enhance returns. And this is done through a disciplined capital allocation framework. And fourth, we have a very strong financial position and will continue to actively manage our market and insurance risks to lower volatility. I'm optimistic about the outlook for Aviva to achieve this growth in value and cash flow. Growing the value of the company safely is my key objective as CFO. Let's start by looking at the financial targets. As Maurice mentioned, our targets are based on economic metrics, with IFRS disclosures used mainly to enable performance analysis. We use economic metrics to run the business. It's how we price, it's how we manage risk and volatility, and ultimately, it's what drives our ability to pay dividends. Turning to the targets, I draw your attention to 2 points. First, we've introduced a return on equity target of 12% using economic capital. This is a fundamental building block to increasing the quantum and quality of shareholder return over the long run. I'll talk more about the calculation and business performance drivers in the coming slides. Second, a cash remittance target for 2019 to 2022, so 4 years in total. This level of remittances provides sufficient cash to comfortably cover the dividend and meet our debt reduction target. At a detailed level, our targets incorporate yields in Europe from Q3. Yields have rebounded a little since then, but as we're at the start of our target cycle, I'm preferring to take a cautious stance. Briefly looking at the other targets, OCG links closely to the return on capital. It's included owing to its importance in funding the dividend, and of course it provides additional discipline on managing new business strain. We're making good progress on the other targets we announced in June, namely debt reduction and operating expenses, which I'll come back to later. So how do we think about value? Simply, I'm trying to grow the book value of the company and to sustain healthy dividends each year. We'll aim to do this by enhancing ROE through disciplined capital allocation and cost efficiency. We'll control volatility to underpin the sustainability and the investor confidence in our resilience, and also to deliver growth and demonstrate franchise strength and execution. We've delivered good progress over the past 3 years. Since the beginning of 2016, we've paid out 90 pence per share of dividends and increased book value by 80 pence per share. That's a total return of 170 pence, or 52% over that period. By enhancing our return on equity, we will have high quality and attractive return profile for our shareholders in both NAV and dividends. Now let's take a look at the return on equity target. This is simply calculated as own funds generated in the year as a percentage of opening own funds, all based on unrestricted Tier 1. This is at a group level and is after all debt and preference share costs. ROE is important in measuring the productive use of our economic capital. First, we use economic capital to ensure sound risk-based management. And second, in the capital allocation process, we balance returns and payback to manage the impact on cash flow. We've set the ROE target at 12%, which is a strong return. As you can see on the slide, it was slightly above this level in 2018, although that was helped by the relatively large contribution from management actions, which we also expect to be the case in 2019. Our 12% target reflects a meaningful improvement in the underlying return, and the target includes management actions in a normalised range of approximately 1 percentage point. As we shift our emphasis to economic metrics, it's really important this doesn't turn into a black box financial modelling exercise. But I'm keen to provide more details on the capital generation in each division. At the half year, we provided you with more disclosure on the capital figures so you could see the contribution to own funds and SCR from new business and the in-force book. Before looking in more detail, it's worth noting that the divisional return figures are unlevered. They're return on capital figures. Leverage increases return on capital to group return on equity by around 2.5%. For now, we present UK Life and the Investment, Savings and Retirement division together, given their close alignment and the inclusion of certain savings businesses within the UK Life legal entity. For that combined division, we're targeting a 9.5% return on capital. This is weighed down by the amortisation of transitional measures of around £350 million per year and reflects a conservative long-term assumption for management actions. In general insurance, our target is a 14% return, which will be delivered as we improve the combined ratio to our 95% target. Europe Life's returns are slightly lower, with a significant negative one-off item in 2018 in France, and of course, the low yield environment. However, our plans in Europe reflect improving returns. We will be trying to grow new business valuably, improve returns, and improve cost efficiency, particularly in the Irish Life business. In Asia, a return of 10% in 2018 reflects the immaturity of a number of the businesses. Following the strategic review, we expect the returns to improve to around 15%, in fact well before 2022, recognising the strength of our core Singapore and China businesses. Our expense target remains unchanged at £300 million, but we've made some adjustments to the baseline. First, we adjust for the expected divestment of Friends Provident International. Second, we've added in amortisation of internally generated intangibles, such as software, to operating expenses. I highlighted this item at the half year. It's an accounting presentation change that we've made to improve earnings quality. Third, we've removed levies and premium taxes. These are directly linked to premium volumes. For example, this will align Canadian premium tax more closely with IPT in the UK. Taking this all together, our controllable baseline for expenses is 3.9 billion. So on an equivalent basis, after allowing for our 300 million cost reduction plan and absorbing around 200 million pounds of inflation, that means we're targeting a cost base of 3.6 billion in 2022. We're making good progress on the cost reduction from a broad base of initiatives. The key actions underpinning our 150 million of in-year savings projected for 2020 are lower functional and head office overheads, lower investment spend, and the integration of UK Digital with UK GI. Let's now turn to IFRS, where we're making some changes. While we haven't set external targets for IFRS op profit or EPS, it's an important metric that helps comparisons of how we're performing. One of the things that was important to me when I took on the CFO role was to improve the clarity of our financial disclosure. As an insurance company, there's going to be some complexity and volatility caused by market movements, claims experience, and management actions. Looking forward, our IFRS earnings will be closer to cash flow. We've previously announced that Friends Provident International is to be divested, but it has and it will remain in profit until completion. As just mentioned, internal amortization is now included in operating profit and operating expenses. And we've said for some time that management actions had been elevated due to longevity releases and would return to more normalised levels at some point. For 2019, we estimate management actions of 300 to 400 million pounds. In 2020, these are expected to step down, and in the longer term, our guidance for this item is in the range of 0 to 200 million pounds. Importantly, none of this has any impact on our cash guidance or our debt reduction targets. And looking forward, profits and cash flow will benefit from lower interest expense and our cost savings. Having covered our targets on return on capital and expenses, let's turn to cash flow and the building blocks of our target of £8.5 to £9 billion for the 4 years ended 2022. You can see from the chart that we expect £7.5 to £8 billion of cash from the business units. This is more than enough to fund debt interest and central costs and to pay the dividend. The business units' targets include £0.2 billion of costs related to achieving the expense efficiencies and reflect lower forecast dividends in France. Moving across to the right, longevity and other factors are expected to contribute £500 million of special dividends in 2019. We've also made further progress on proceeds from divestments. £0.2 billion from Avipop has been transferred from Italy up to Group Treasury. Our forecast cash flows are fully supported by capital generation. Our Group OCG target is £7.5 billion and is after allowing for all debt, interest and central expenses. If you simply add back those two items, it's clear that the expected business unit OCG underpins our planned cash remittances from the BUs. I should note that remittances from our UK life and savings businesses are expected to be slightly above OCG over the 4-year period. This is due to the strong level of capital generated in previous years and the special remittance in 2019. As you can see, we pay out close to 100% of OCG in general insurance. And as mentioned, in Europe, our cash flow forecast is conservative. And in Asia, we are retaining some capital for growth. Let's move our focus away now from the targets and towards capital allocation, which is a question I get frequently asked. Maurice has spoken about rationalising our investment, but we're far from starving our businesses. On the contrary, the cash and capital generation targets I've just outlined are net of significant levels of ongoing investment into the business. Using this investment productively is critical to generating returns on capital over the long term. Our approach brings together 3 elements. The first is strategy. Our strategy centres on customer experience, investing in the business fundamentals, and we're also investing with a commitment to grow the business. And in fact, when we focused on those priorities, there are notable success stories. The second is the financial framework through which capital allocation decisions are made, which brings together returns, change spend, capital budget and cash. And the third is execution, What capabilities and external conditions are required to succeed? We know we need clear advantages to beat our competition. Together with Maurice, myself and our new Chief Operating Officer, Erica Arnold, will lead this process. It will be robust and fundamentally aligned to our objective to sustain growth in returns and dividends. Our economic value-added framework underpins our financial decision-making. It ensures we make decisions based on creating value. EVA ties closely to ROE. It's simply own funds generated less the cost of capital for each year. We use EVA both to make larger strategic decisions, for example, transformation projects or M&A, and decisions every day, e.g. on new business pricing or managing our investments. To avoid J-curves, we overlay payback, again using economic metrics as an additional discipline. As the diagram illustrates, we use EVA and payback together to shift our capital and resources toward the top right. And we've used EVA to support a detailed review of each segment of the group to inform our planning and our performance improvement plans. What does this mean for new business investment and growth in appetite in practical terms? As you might expect, given the strong returns, increasing our weighting to general insurance with returns of 14% is an attractive prospect. In his presentation, Colin will take you through his ambition to grow the business profitably, maintaining our momentum in commercial lines and delivering improvement in personal lines in the UK and Canada. In life insurance, we're being selective and using EVA and payback to help drive our strategy. In UK life, we're allocating a little more capital to grow further in bulk annuities. EVA gives us pricing discipline and helps us optimise asset selection and reinsurance. Returns in BPAs are typically in the low teens. We're seeking to grow our modern savings, retirement and investment business, which consumes much less capital and makes a very strong contribution. In Europe, we're actively moving from traditional savings products to more efficient unit-linked and protection. This will take time, but Patrick Deesnerth and his team are committed to making progress. In Asia, our strategic review is informed by EVA. EVA captures well the value of new business growth. Within each business, EVA has helped to drive discipline in product mix by avoiding products such as universal life and interest rate mismatches. Now let me turn away from new business to how we'll invest sensibly in the business improvement. Maurice has committed us to bring down the overall level of investment spend, to increase commercial rigour, and to improve customer experience, and to ensure accountability for delivering the projected benefits. Our plans and targets incorporate approximately 1.3 billion of business investment over the next 3 years. Let me provide some colour on our investment in 3 of the main areas. First is technology. We've been investing for a number of years in modernising our IT infrastructure. We've migrated to modern data centres and to the cloud. And we've improved customer and end-to-end processes and upgraded our product systems, such as Guidewire, in the GI businesses. This revamp will continue in 2020 and beyond. And the business heads will talk about this further. The second is investing in growth initiatives. This is where we're developing new propositions and enhancing the customer experience and increasing productivity with our distribution partners. Included within this is continued investment in our digital front end and also the hiring of new talent in targeted areas to improve capabilities. The third area is mandatory spend. In our regulated industry, there are always specific projects requiring funding. In the past, such as GDPR, and going forward, IFRS 17. I've spoken about our focus on returns and growth and how we're allocating capital to achieve our objectives. An important underpin for this is a strong and resilient capital position. So let's spend a moment talking about what we're doing to manage capital and risk and maintain that strength and resilience. You're all familiar with our group working range of 160 to 180%. Notwithstanding the various fluctuations we've seen in investment markets over recent years, whether from Brexit, low yields, or volatile equity markets, Our solvency cover ratio has typically been in a range of 190 to 200%, and that's as well as deploying 2.4 billion of cash to reduce hybrid debt and returning capital to shareholders, over and above our ordinary dividend. Resilience is clear in our Q3 numbers. Despite the challenges of negative yields in France and of course the payment of our interim dividend, our group capital ratio has increased by a percentage point from the half year to 195%. And we have 2.2 billion of cash in treasury at the end of October. But we can't predict the future. But we can provide you with an indication of how the group cover ratio would perform under a severe stress scenario. This scenario is across multiple factors, notably UK property and equity, both down 20%, and credit spreads at 200 basis points. In a probability sense, that's a 1 in 15 for equities, 1 in 45 for property, and a 1 in 100 for credit, all before diversification. Faced with this severe stress, we estimate our group cover ratio would fall by around 33 points and therefore just still be inside the working range. Just as importantly, cash flow would still be sufficient to fund our dividend, albeit we'd probably defer our plans for debt reduction. Standing back, with some uncertainty in the external environment and our debt reduction plan, it's good to have some extra flexibility, and it's comfortable to be slightly above our preferred range. However, if the ratio was above 200%, for example, for a period of time, we would have scope for additional actions, such as further debt reduction or deployment of more capital into the business, or via M&A. But that's not a topic for now. An important part of strengthening our financial position is our plan to bring down debt. I can confirm our intention to reduce debt by 1.5 billion by the end of 2022. This will reduce interest expense by approximately £100 million per year. And in the long term, we expect our interest rate bill to fall further as we refinance with much lower cost debt. As a first step, we have just called £210 million of sub-debt, which in fact will be repaid tomorrow. By the end of 2022, we expect to have less than £7.5 billion of total debt, which would bring us below 30% total leverage ratio on both a Solvency II and S&P basis. This is a ratio we will target over the medium to long term, although there may well be periods where it's higher or lower, depending on business needs or market conditions. For many years, we've managed down our exposure to interest rates, and we remain strongly capitalised despite historical low yields. However, negative yields are a new challenge, especially in Europe, where a substantial proportion of our savings products carry guarantees. As Patrick will highlight later today, our back book is relatively well positioned, with the vast majority of our guaranteed savings products providing only a 0% annual guarantee. We can manage the real-world impact in the short run, as our investment returns comfortably cover the guaranteed amounts. However, low rates do create headwinds in local solvency ratios that can weigh on cash remittances, and that is reflected in our revised targets. For our in-force book, we have established good hedging strategies that mitigate the risk of further yield deterioration, but this does not entirely protect the economic balance sheet, so there remains a sensitivity to downside for yields. An equally important factor is what we're doing on the front book. If yields remain at negative or even low levels, guaranteed product structures in countries like France will remain intensely challenging. We've been active in switching our mix away from participating and toward unit-linked and protection. This will continue, and in fact, we're looking to accelerate it. While in the current environment, there's naturally a big focus on market risk, it is just as important that we're good managers of insurance risk. Over several years, we've demonstrated that we're very good at pricing, underwriting, and claims management, delivering attractive and relatively consistent returns in both life and general insurance. We also protect our cash flow and balance sheet through our carefully structured reinsurance programs. In general insurance, we tightly manage our exposure to individual events, retaining £150 million for a major event. And we have protection in place for a series of smaller cats with £170 million retention and a separate programme for significant single risks. And it shouldn't be underestimated how important it is that we have reinsured all of our historic exposure in areas such as asbestos, for example. In life insurance, we use reinsurance extensively in UK protection and more recently in UK annuities to improve capital efficiency and to protect returns in BPAs from longevity experience. My focus as CFO is to grow the value of the company safely. We've got a strong plan to do that. Our dividend is comfortably covered by capital generation and cash flow. We'll continue to increase the net asset value per share. We'll bring down debt leverage further and maintain a healthy capital and cash surplus. We start in a strong position, but we can do better by delivering stronger and higher quality underlying returns and growth driven from customer focus, business expansion, and management execution. This will require making Aviva simpler and running the company with commercial rigor. We have the plans and tools to do this, and with the changes I've seen inside the organisation in the past 6 months, I believe we're on the path to realising our full potential.
Okay, ladies and gentlemen, we'll start the Q&A session now, please.
Give me a second, Chris, just to get everything loaded up here. Or you can dance while I just get my...
You don't want to see me dance.
No, fair enough.
Ashik.
Hi, good afternoon. Ashik Masadi from JP Morgan. Just a few questions. I mean, one of the slides I saw that you're starting your cash position with 1.6 billion. You're expecting to generate or remit cash flows, and then you have some holding company costs. But net, you're retaining about 6 billion that is supposed to be deployed over the next 4 years, which is around 4.5 billion dividend and around 1.5 billion of debt reduction. So, I mean, there's not much room buffer in place if we believe that 1.6 billion is what you think you should be retaining at the holding company. Credit market is really benign at the moment, probably all-time best. So would you not consider having some buffers in place just to make sure that your debt leverage and the dividend plans are absolutely safe? That would be the first one. Second one is, I mean, if we go back in past, I mean, the growth has always been a focus in GI, in asset management, life and savings. And that's what we hear today as well. So what has changed? What gives you more confidence that this time we will be getting that growth, especially, for example, like a couple of numbers I saw in the early presentation, 10 billion flows in Aviva Investors, 10 billion flows in the retirement business. So what gives you more confidence around that? I mean, Asia is clearly structural growth, so I wouldn't doubt that too much, but any thoughts on that life and retirement business? And last one is, in your OCG 7.5 billion number, can you give us some guidance as to what you're assuming for SCR change? Are you assuming a release or addition because of growth? Any numbers around that would be great. Thank you.
Great, thanks, Ashley. I think we'll start. Jason will take the first question on cash. I'll then take the growth, and that'll give you then time to get ready for the OCG, which you can take as well. So,
well, I'm actually going to start with the OCG one because that's where it all starts from in terms of the cash flow. Is the building block of the future cash flows is the capital generated within the business. We are seeking to reduce capital deployed hugely in the organisation, so the SCR is ticking up but slowly. In 2018, we had a big release from SCR, you might remember, within the OCG, but going forward, it's a more normalised level. The new business strain, which is sort of one way of thinking about it, is not going to change hugely. It was around 200 million to 300 million a year looking forward. Your first question around the cash flow targets are all built off the total OCG. So we've got that produces the cash remittances at the divisional level that we've set out. What I've tried to do is give you the confidence at a BU level where the return's coming from, so you can work through the return, the capital that is required, and how the remittances flow up. And you can build your own model as to where all of those cash flows come, and that more than covers the dividend and the debt reduction plan, including in various stress scenarios, which is why I set out the stress play so you could see the strength of the company through different times.
Yeah, Ashik, let me talk about growth. So first of all, I agree with the underlying sentiment. I think if you take Aviva over the last decade, we've not demonstrated growth. For any business to be viable, you do have to grow your revenues and your customers. And we're setting out some pretty aggressive plans today. And I'm really confident. And let me give you a few examples why I'm confident. So I'll start with, you mentioned first the general insurance business. Our general insurance business actually, since Warsaw, our last sort of major capital markets day, has actually grown by 25%. Now I realize about 7 or 8 points of that was the inorganic deal with the Royal Bank of Canada. But we have actually demonstrated growth there. And if I look at that business, we're seeing strong growth in the SME market, both in the UK, France, and Canada. We're starting to see growth in our personal lines business, particularly in the Canadian market, where we're seeing hardening prices and better margins. I mean, the Quote Me Happy story is a great example. If I move to our new business and our new division in terms of savings, investment, and retirement, I mean, what gives me confidence in the 20 billion net flows per annum is you just have to look at what's happening currently in the workplace and those 3.5 million customers. We're also winning new workplace mandates. We've kind of gone from nowhere to somewhere in terms of IFAs and moving up the league table. I think when the final numbers come out this year, we may have the second strongest flows from the IFA market. I think the underpinning in Aviva Investors and turning around the investment performance, I want to say about 70% of our funds are now in the top quartile over a 5-year period, and we've seen that translate into decent third-party flows. If you take our biggest business here in the UK, our UK life business, we're still seeing strong demand for our products, and we're actually guiding that our new business, even if flat, would generate increasing cash flows over the next 10 years. So for me, in creating this team, it was incredibly important that, Aviva was done squeezing the lemon. We've got to be a business that's viable and grow, because that ultimately underpins, future value down the road. So I am confident in the growth targets.
Andrew Crean, please.
Good morning, Sandra Crean, Autonomous. 2 questions. I'm just coming back to Ashik's question. The slide on the progressive dividend going out to 2022. From what I can see from the slide, the closing cash is about 2 billion, but I think that's before the 1.6 billion investment and the reduction in debt of 1.5 billion. So that doesn't look as though it's developing particularly strongly. And then secondly, on the strategy, I think the board, when it originally set out the strategic question, made the point that you had critical mass in the UK, but you were subscale in all your other markets. I just wonder, from a strategic point of view, how your answer actually deals with the question of being subscale overseas.
Okay, thanks, Andrew.
I can answer the first one quickly. It's net of the 1.3 or the 1.6, including the cost. That's already before the remittances are paid. So as the capital generation, cumulative over 4 years, is 7.5 billion. That's after that investment's all been paid within the business units. So all of the dividends are post that investment through, so that you don't have to pay that again. And that amount in that waterfall chart is available for dividends and debt reduction.
Andrew, let me talk about the strategic question. I'm sure I'll get other questions that pick at various nuances. In going through this process, I think, and I committed previously that I'd certainly leave no stone, unturned and consider, all options. My primary focus is absolutely on running this organization better, getting the basics right. I'd be the first one to say our delivery over the last 5 years is arguably, disappointed on more than one occasion. I believe there's significant upside in Aviva in getting this right, focusing on the fundamentals, whether that's better pricing, whether that's enhanced, distribution, whether that's getting the efficiency measures, which is why I sort of set out, the cost targets in day one. I'm setting out today a simpler strategy, a far simpler structure. I believe we've, to Ash's question, put forward some pretty attractive growth engines. This is from a business that arguably hasn't grown, in the last 5 years. Fundamentally, I needed to improve the performance of the business. I mean, I think that's been kind of holding back. I always describe it as good performance, but not good enough, particularly in markets where I believe we do have competitive advantages. We have certainly competitive advantages, as you mentioned here in the UK. I think we've got a competitive advantage in our Canadian business, and certainly in parts of Europe where we play. We're number 2 in Poland. Certainly, even in our French business, in the markets and segments that we go after, we're number 4. We've gone from number 12 to number 5 in Italy in 3 years. And I think if you look at some of the portfolio actions I'm taking in Asia, we're announcing today the exit of Hong Kong. That was a non-core business. It was never going to make the sort of returns. So I'm getting the capital out of that. I've announced that I'm under strategic review both in Indonesia and Vietnam. But I'm absolutely staying in Singapore, where we are one of the market leaders. And I believe that our distribution footprint and our partnership with COFCO in China gives us real chances to succeed. So I concur with the undertone of your question, and it's one of the things I'm focused on. And frankly, ultimately, it's about delivering stronger cash flows and stronger growth to sustain why investors hold Aviva, which is the dividend.
Johnny Vo, please.
Hi, it's Johnny Vo from Goldman Sachs. Just 3 questions, if I may. Just the first question, Jason. You've provided a stress scenario. In that stress scenario, obviously your subs would fall to a very low level. So of the central liquidity, how much of the central liquidity would be consumed to reset the subs back to a commercial level? That's the first question. The second question is in relation to capital allocation. Obviously UK Life is a low return business, IS&R is a high return business, but certainly quantum of profit and capital generation is much higher in BPA business than it is in IS&R. So how do you make the determination of capital between the two, despite the return profile? And the third question is just in regards to the Asian disposal process. Obviously, there was a process. Are you closing the door now on a disposal at some point in the future, or is it completely off the table? Thank you.
Great. Thanks, Johnny. I'll take the third question. I think Jason will take 1 and 2. I may add some color on the second one, but Jason, why don't you start with?
Sure. So with the stress scenarios, trying to show the group, under pretty severe stress, it builds on some of the stress test work that we do with the regulators during the course of the year. We say, actually, I saw some estimates in notes, and I thought, actually, let's put out some facts rather than the single stress sensitivities, which I don't think are that illuminating, because, as you know, single stresses don't ever occur in the market. The BUs are all capitalised well. We maintain good capitalising. We don't carry huge amounts of excess capital. I think that those levels that I set out, obviously depends what exactly happens, but we don't assume, and that under this scenario, that we would need to recap any of the business units. And I made that comment that cash flow we could retain under this scenario. That would probably require us to pull down some of the group cash resources and defer the debt reduction plan, because we wouldn't have the same dividends and solvency clearly in such a scenario, but we could continue to safely operate the group and pay the dividend, and that's really the test that we applied when we were looking at that. On the capital allocation, we like having a balanced business. We like having a diversified business with different growth opportunities, so we're not beholden to one or the other. But we also keep value and cash flow absolutely at the heart of the decision making. So the BPA business, I think myself and predecessors have been asked that question every time we've been on this stand. We've continued to build our confidence in it and to get very clear what the level of return is and how much capital we want to allocate to it. And you can see we're announcing today we're kind of closer to 4 billion this year compared to 2.5 last. So we've continued to grow that business and make really good returns in it. And as you say, the quantum of capital deployed is good. We're making low teens returns, and Angela will talk about that a bit more this afternoon, about the shape and the attraction within that return. But we're not going to become a BPA business. We want it to be part of what we do, not what we do. And the savings business, we've already got good scale in it, but we can continue to grow that. Frankly, as much as we can, it's really constrained by expense and ability to actually win hearts and minds of distributors and customers. And that's what you and Lindsay in the new initiative will be, is to try and expand that business.
Johnny, the thing to me on capital allocation, we've had frameworks in the past. This is more than frameworks. This is about a culture. It kind of starts with really two things. One, about accountability. So anyone in Aviva that asks for capital for a project, guess what? It forms part of their bonus. It's amazing just putting that out there, how the asks change. We've never seen a bad return on investment business case before. It also is about the commercial rigor. So we have a framework. We had frameworks in the past. This is all about a massive cultural change in terms of capital allocation. It's a scarce commodity. I don't want to starve the business, but I want to make sure we get the right balance. In terms of the Asian process, as I alluded to in August, we set out a strategic review. I was pretty candid at the time. I know people love to think that's code for sale. I think I said, on several occasions, we may look to do more with joint venture partners. We may look to invest. We may look to sale. There was a sale process that was part of that. We did receive numerous expressions of interest, and as it relates to to our jewel in the crown there, quite frankly, those were nowhere near the value that would accrete to Aviva in keeping it. So we made a decision to stay with Singapore. I'm delighted by that, given the circumstances. We've always, liked the Chinese business in terms of one of the biggest markets in the world, and we've got, a strong footprint. We actually control our management team, which, many people don't, and probably one of the best partners. I think what's really important, as we now sort of, clear out things that were never going to move the needle, quite frankly, things that were actually, both using cash and capital, it takes the entire region and will turn it in, to a net generator of cash. I think people that don't know much about a Singaporean business will be pleased when they see Nish's presentation tomorrow in terms of what he's done strategically in that market and what that sets forth. And I'm now moving forward to run these businesses better. It's an important part of the group. So that's the conclusion.
Can we have a question from Abid Hussain, please?
Morning, thanks for taking my question. I've got 3 questions, please. Firstly, on the cash remittances. Am I right in thinking there's been a downgrade since your June Investor Day on the quantum of the cash remittances? So I think you're targeting 8.5 to 9 billion over a 4-year period. I think you previously said something like 7.9 billion over a 3-year period. So it feels like on a like-for-like basis, we're looking at a 1 to 1.5 billion downgrade in the remittances. If so, what's driving that? Could you just explain that? The second question is on the local subs in terms of the capitalizations. How close are the local subs to your risk appetite in terms of solvency ratios? And then just finally, on your international JVs, how happy are you with the JV partners, in particular in China and India, given that neither of them are focused on financial services?
Okay, thanks, Abid.
Shall I kick off on the cash?
Yeah, we can kick off on the cash.
We've established a new target for 4 years based on the new plans, the capital allocation and the strategies that we've set out. The 2 differences from when the comments that were made a few months ago. One is that we're paying the approximately 300 million within the business units, I think 200 million actually, within the business units to achieve the expense efficiencies. And 2 is France. France won't pay a dividend in the second half and is unlikely to pay a dividend next year, which is a segue into your second question around subsidiary level of capital. It's actually, we are above risk appetite in each of the subsidiaries. To achieve that in some of the European markets, we've taken actions, both hedging and non-payment of dividends, if you like. So we are in a position where we're comfortable from a capital perspective, but we need to improve the business and take further actions before, particularly France, will return to dividend paying.
Local subs and risk appetite, you want to take that?
Well, I mentioned France. I think there's nothing to say elsewhere. All of the other businesses are properly capitalised in the way that we're happy with.
But let me talk about some of our international partners. We've got a number of partners, and I think we're very fortunate, as Aviva. Royal Bank of Canada is one of our GI partners. We just extended that partnership by another 4 years. It's the #1 brand, in the marketplace, and we see strong growth prospects from having that partnership for years to come. We've got a great partnership with Santander and ING in Poland. We're seeing strong growth there. Certainly here in the UK, we partner with 4 of the big 5 banks. UCI and UBI are strong partners in Italy, and we've seen the benefits there. I think on China, COFCO is a phenomenal partner. I mean, COFCO credibility is off the charts. It opens up access to so many things in China that other foreign insurers don't have access to. And most importantly, we control the management team. I think the last one you mentioned was India. We've been, as I think I mentioned last time we spoke, looking to expand our partnership to get additional distribution in that attractive market. So overall, I think Aviva is blessed with having great partnerships in our international businesses.
Oliver Steele, please. Oliver Steele, Deutsche Bank. 3 questions. First is, you've separated out the management, as I can see, in the UK between ISNR and UK Life. Are you planning to follow that up with a separation of the legal structure and the balance sheet structure? And if so, does that mean that you could at some stage sell off part of the UK legacy business? Second question is, can I just dig a little bit deeper into the European Life cash remittance? The question may be redundant in terms of what you said in France, but it seemed to me that I think you paid something like 400 million in the first half of the year from European Life. And you've always said that Poland pays out more than its profits because they have excess capital there. I'm trying to rationalize the numbers. It seems as if you're really cutting back on the non-French projection as well. Perhaps you can just give us a bit more detail on that. And then the third question is, just so that we can try and work out what's new and what's not new, can you break down the 1.3 billion of investment in the business as to what makes that, how much of that should we have known already in our existing numbers?
Okay, let me start, Oliver, with the first question. Jason can take the second. We probably both can chip in on the third. So our new division, investment, savings, and retirement is fundamentally set around a societal problem. Societal problem is helping people to save, obviously, for the retirement. The genesis right now is all about the consumer. And when we look at Aviva, we've got effectively, it's an existing business. It's not a new business. This is us bringing the component or constituent parts together so that Aviva can better serve the needs of customers. And whether that's their first job and, those first choices on a DC fund around how they're going to save and ultimately accumulate, to us then talking about, protection type products through the life cycle of one's life, or then helping them think about, retirement, whether that be an annuity type product, a modern drawdown, or equity release. So at this point, we're very much running it as a division. Lindsay Ricks is the CEO reporting into Ewan, and the manufacture of those products both comes from the existing Aviva investors and the existing UK Life story. I think it will be important, and you should expect this from us. We'll report on performance in all 5 divisions. Obviously, we need to get to a baseline in this newest one, but at this point, legal structures remain as is. European.
Yeah, and you're the second question. Look, I've got no appetite for restructuring the businesses. It wouldn't achieve very much. Would probably be inefficient. And the UK Life legacy question, I think, was sort of similarly. Like, again, we look at the way we deploy capital and the back book, particularly in the UK. I talked about this at the half year all the time, and we make sure that we understand where the returns are, the capital deployed. It is efficient. We manage it well, but we constantly review different options. The European Life subsidiaries, actually, Poland paid its dividend in the first half, so that there was. I talked to the half year about phasing. There was actually quite a lot of capital came out of the European businesses in H1, which won't be repeated in H2. Partly planned, partly because of what's happened to the interest rates. So that's the position there. The other businesses. Ireland's only really set up as a separate subsidiary in March. It's sort of finding its feet, but it's got good levels of capital, and as I said, needs to improve its performance. Italy is doing fine. We paid up the 200 million from the Avipot proceeds last month, and Poland continues to perform well.
Perform well, very well. Let me talk about the 1.3, because it's actually, and it kind of builds on the question from Johnny. We were on a run rate of certainly around 600 million a year, and if you looked how that was allocated, and I think Jason kind of alluded to it without numbers, it went really across 3 buckets. So sort of growth, fix, and mandatory. If I step back, there was far too much in fix. A lot of stuff was probably being classified as mandatory when it wasn't. But the broader conclusion, there wasn't nearly enough in growth. So first of all, there's an emphasis, to move into the growth bucket. I think the other thing which comes to the rigor and the accountability. So the accountability is quite simple. If you're asking for CapEx, then it's going to form part of your bonus. That is a non-negotiable. Somehow it was funny that you're held account for OpEx, but not CapEx. So that's changed. But I think the other important thing, and this is around the allocation, actually who gets what. That goes back to the framework. That goes back to to Jason's EVA chart. If you're going to compete for a scarcity, which capital is, then we need to sort of see what's the returns. We also need to know what's your track record of delivery. We've had many a pipe dream, right? I'm actually pretty thrifty at my heart, so there's not a single project that Jason and I probably won't scrutinize over about £1 million. So we're going to expect delivery.
Can you pass to Blair Stewart, please?
Thanks. It's Blair Stewart from BofA. Ollie's asked 2 of my questions. He must have been looking over my shoulder. I've got a couple left, though. The Solvency II ROE, you talked, Jason, about that being own funds generated divided by own funds. When you say own funds generated, does that take account of movements in the SCR? And what's to stop you from just writing a lot of BPAs that generate lots of own funds but absorb SCR? Can you clarify that, please? And secondly, what levels of cash can we expect from the Asian businesses, please? And I guess the third, just really an observation that, to your own point, Maurice, these businesses have disappointed and they haven't grown over the last few years. And aside from just a bit more clarity and focus and a different management team, they're the same businesses. What's actually going to change here? Is this just going to be another false set of promises, with all due respect? Thank you.
Yeah, no, fair enough. Thanks, Blair. Jason, why don't you take the Solvency ROE question? Maybe we can both talk about Asian cash, and I'll talk about what's going to be different.
Yeah, of course. I mean, we've set up a suite of targets so they all hang together. The Solvency II ROE, I suppose we could just inflate it, but we'd run out of capital. So our OCG would fall and our cash flow would fall. So it would be a very short-term strategy to inflate it and wouldn't work. And the way that we use EVA, that is embedded through the business. That stops us, making those mistakes, and we continue to produce, good capital and good cash flow return. It's not one or the other; it's both, and that's how we manage the subsidiaries and the group overall. In terms of cash from Asia, are you talking about divestment proceeds as rather than dividends? Dividends. So yeah, looking forward, I mean, Singapore paid a dividend in 2019, slightly outsized normal. Continues to pay. I think a run rate might be around 30 to 50 million over the period. And China's sort of is a healthy single-digit sum each year, but we'd expect that to grow over the period. So it's contributing, and it demonstrates they are both slightly more mature businesses than Indonesia, Vietnam, and the others.
I think the other important thing on Asia, if you look forward, 3 to 6 months, and we have pruned our presence to the 2 core markets, we also have to then rethink about our operating model and our support mechanisms in the region. So those will be accretive. Listen, I think it's absolutely the right question to ask on why is it different? Why should one believe in Aviva? It's kind of why I took this job, because quite frankly, I recognize the disappointment. In one sense, at worst case, it'd been a bit of a value trap for 10 years, and certainly over the last number of years, just when you get momentum, there turns to be a bit of a surprise. I'm focused on absolutely changing that, and I'm starting by simplifying the company, establishing these 5 new divisions, each with targets and goals. And some of these are, I think, quite challenging, quite aggressive targets. We're providing investors with extra detail and additional confidence, on our dividend sustainability. I actually think that the world that we live in, that may twist and turn in the next little while, the kind of yield that we're offering is attractive both to institutional and retail investors. We have 500,000 of them. We're guiding for 8.5 to 9 billion, and being prudent. Jason's being transparent on what we're assuming, out of Europe. This allows Aviva to grow. I think the 1.3 billion will underpin growth. It'll also underpin the kind of investment that we need to make, and we're guiding that we're going to reduce our debt. And my ambition, make no mistakes, is to grow the organization. I have a simpler company. I have clearer targets. I have a new management team. They're not all here yet. Frankly, you're never going to see any one of us not speak with honest candor. We're going to be far more transparent, both in signaling our actions and how we measure ourselves against them. There will be no nonsense. There'll be no false promises, and there certainly won't be any gambles on crazy ideas. I think it'll take a little bit of time, but getting back to the basics and running this place better will pay dividends. There's nothing wrong with being a conglomerate. There's a lot wrong with having businesses that don't perform. So I'm going to run the place better. I think for our investors, it's all about attractive dividend. That's paramount. And I'm fortunate. I start with a company that's in a good position with a strong cover ratio and strong liquidity to face whatever may come in the next 6 to 12 months.
Colin. Thank you, Colin Kelly, UBS. Firstly, on the return on equity target of 12% by 2022, the business achieved that in full year 18, albeit supported by one-off management actions. If we run forward with the guidance for management actions, and if we allow for the interest cost reduction and also the other cost reductions that are targeted, we probably won't be far away from that 12% return on equity again by 2022. So is that a conservative target, or are the targets at business unit level and the improvements you expect fully incorporated into that 12% return on equity target? That's the first question. The second question is really on business mix. So what's very clear based on your targeted return on capital is that general insurance non-life is a very attractive area to recycle capital into, and one way of enhancing book value growth. Given the dividend and the debt reduction target, and also the 1.3 billion flagged for reinvestment, is there additional flexibility available to pursue opportunities to accelerate a shift into non-life, or a better balance between life and the non-life business? Thank you.
Great. Thanks, Colin. I could hear you. I couldn't see you. Where are you? Oh, over there. Great. Nice to see you. Listen, why don't you take the ROE,
Sure.
and I'll take the business mix question.
Yeah, you're right. I mean, it is slightly awkward to be announcing a target slightly lower than your historic number. But there is a significant contribution from management actions in that number, from mainly longevity. And we'll see that again in 2019. So as I said in the script, we will have a higher quality number going forward. My guidance is around 1% of the return will be in management actions and other going forward. So that's a materially lower sum than we've seen in 17, 18 and 19. In fact, around other business units being pushed to deliver a better return? Absolutely. We'll go through that this afternoon. Each one has got a demanding, achievable plan, but demanding plan, which is a contribution from margin improvement, from cost efficiency, from capital allocation across the piece. And we're going to continue to be demanding. And if by 2022, we're hitting the straps, maybe before that, then we'll think about whether that's the right target.
Common business mix. I'm not coming out with a specific percentage target. I think what I have said, and take those as directional things. I said I believe we're underweight in general insurance vis-a-vis what our natural market share should be. There's a reason we've set up our investment savings and retirement division. We think there's a tremendous societal and consumer need, and we think Aviva certainly can win. So that's certainly two businesses that, frankly, we're going to want to grow. We also very much like the protection business. Specifically, if the right opportunities come about, and I'm talking about organic opportunities, of course we have additional flexibility to make investments in partnerships or support growth. I think the other thing that's actually key, our UK Life business is an amazing business. I think I described it as a cash flow machine. And I think when you see Angela's presentation this afternoon, one of the things that actually people often mistake is the new business strain is actually quite efficient there, and we need that to generate the replacement cash flows. If the other part of your question was the inorganic, I'd be quite honest on that. I think myself and the team, it's going to take some time to earn enough stripes before we ever consider anything like that. So we've got some tremendous opportunities right in front of us, and we're going to execute against those.
Dom O'Mahony, please.
Thanks, Dom O'Mahony, Exane BNP Paribas. I'll stick to cash and capital questions for now, if that's all right. So firstly, on management actions, 1.1 of the 7.5 OCG over the period is going to come from management actions. And I get that a lot of that is nailed on from presumably longevity releases in H2 19. But going beyond that, we've all seen the CMI data. If anything, CMI 19 looks a bit worse, or looks like it might be a bit worse than CMI 18. Why do we think that 200 million a year is a reasonable number going forwards? Where does that come from, given that longevity may not be a major driver going forwards? Secondly, in terms of cash management, you still have a relatively large internal loan, which I think probably funds half or a bit more of the cash balance at the centre. What is your approach to that? Does that number have to come down over time, or actually are you happy where it is? What's the governing philosophy around that? And then finally, just on the heritage life book, you've given disclosure on the capital generation from life and the in-force. I'm just curious as to know how much of the OCG over the planning period comes from that heritage life book in the UK. Thank you.
Dom, I think you've basically hit a home run for the CFO, albeit I could probably answer some of them, but I'm going to hand them over to you, Jason, on the CMI tables.
Well, thank you. I'll go in reverse order. On the heritage side, we've got further disclosure we're going to make this afternoon in Angela's presentation about the capital contribution. But heritage it's not that dissimilar to the IFRS amount. So I think it's 300 million pre-tax, as it runs off. So the scope of that heritage book certainly has been disclosed today. Is around that level. The internal loan, I think it's about 1.25 billion now, so down dramatically from 6 billion in 2012 when it was first established. It's a very comfortable amount, within the subsidiary. We do keep a close eye on it. Having said that, to make sure that the liquidity within the sub is appropriate and is well managed, and it's in the context of that. We are paying it down slowly, and that's the plan, that it will go in sort of 20-year time horizon, but there's no plans to accelerate that at present. As it relates to management actions, the age-old question, I guess, as to how much can we do with the balance sheet. If you look backwards, under any circumstances and take out longevity, the level that I'm pointing to has been achieved. Across the board. The size of the balance sheet, we've got about 25 billion pounds of capital in the balance sheet, and there are opportunities, to do that we're good at managing capital and risk within the organisation, and it comes from that. It comes from just being, good at managing the business, finding those opportunities, pushing yourself, every year, to find something, and experience tells me that level is achievable.
John Hocking, please.
Thank you. John Hocking, Morgan Stanley. I've got 3 questions on GI, if I may. The GI targets, the expense ratio reduction that you've got penciled in, is that purely because of the top line ambition, or is there actually specific expense initiatives going on in GI? That's the first question. Secondly, what rates have you baked in to the top line? I think the 20% growth, have you got any sort of rate acceleration in that number? And just finally, by geography, can you give us some idea of where some of that top line growth is likely to come from? Thank you.
Sure, thanks, John. I'll take a stab. I think I'll be pretty close, but we may want to get the mic for Colm on some of the specific geographies. I think firstly on the expense target. So we started off with certainly our general insurance business, which is about 30% of the group, having a reasonable allocation of the 300 million net of inflation. So there's a part of that. I think we also, as we indicated when we moved the digital business in, which had about 100 million of costs associated with it, certainly some incredibly valuable componentry that we want to take out, to all of Aviva customers, not just our direct customers. But I did flag at that time that it wasn't as efficient as it should be. So there's part of that. Those are probably the 2 big drivers. I'm sure Colm and the team are also looking to drive efficiency. The one thing that's noted on my slide, and he'll pick up this afternoon, in personal lines, this is now commoditized insurance. And, if you're not efficient, you're not in the game. I mean, our expense ratio, and quote me happy, is at 5%. Our expense ratio, I believe, in our personal lines business outside of that is 13. And that 8 points translates into huge savings for customers. There's a reason we've gone from 0 to 1.4 million customers. Listen, rather than me give probably plus or minus 10% on rate momentum in both Canada, the UK, and France, I think, Colm, you've now got the mic, so why don't you tackle that?
You are absolutely correct, by the way, on the numbers. So. It's 13% is the cost ratio in personal lines. The short answer is it's absolutely about cutting expense. So this is not about grow the top line to improve a ratio. So we're taking 2 points out based on where it is today. And we have the initiatives in place already. So that actually, and I'm giving away some of what you're going to hear this afternoon, that equates to about a 20% reduction in the expense base of our personal lines business by removing duplication and overlap within the business and automating our activities. It also includes an SME, and I'll talk this afternoon about some of the initiatives we put in place to take out low-level renewal and underwriting of small commercial business. So these are absolute expense targets that actually do contribute to 300 million. So the 2% is actually a prudent number, and it's not based on top line growth. With regards to rate, I mean, we don't look at underwriting performance on the basis of just add rate. So, I tend to talk about rate as a permanent solution to an underwriting problem, because what we need to look at is the mix of the business, the amount of indemnity spend we have, and yes, we need to match rate with inflation. So inflation, which we know in the UK in motor and home has been running ahead of what expectations were in the market. The rate we're actually applying is above the rate of inflation. That was needed because the margin on our business has been dwindling over the last couple of years. So there is additional rate going in above inflation, but it's not a rate story. It's a mix optimization story. It's an indemnity story. It's an expense reduction story. And it's a channel choice story from Aviva as to where are we actually going to look to generate our new business from.
Thanks, Colm.
Hi, Tom Howard at Barclays. Just a couple of questions from me. Well, 3 actually. On the stress test scenario that you gave us, can you give some more detail on the downgrade assumption that goes into that credit? What kind of proportion of book, fallen angels, that kind of thing, or is it a rerun of a prior stress test? .com bubble, for example. On bulks, is 4 billion going to be the new kind of run rate? And if so, what's changed in your ability to kind of produce direct investments? Because from memory, you had about 2 billion in 2017, and that wasn't perfectly matched after you did them. And then the last one on, I think you mentioned Singapore and China as your crown jewel. Historically, people would have thought that was Canada, and I wonder if now it's Singapore and China. Thank you very much.
Let me take the third one first. The context was our crown jewels in the Asian region, and they're great businesses. But yeah, no, I wasn't putting them up quite there. Albeit I think they're fabulous businesses. Jason, why don't you take the first? We probably can both take the second, but why don't you start with the stress test scenario?
There is a downgrade assumption in it. Let me check it over lunch, and I'll catch you and tell you exactly what it is. But I think it's about 20% of the bonds get downgraded by a whole category. But I'll come back on that one if I may. I think on bulks, I was in the UK Life business, as you all know, for the last 3.5 years. What we were doing was backing, both the new business, but also re-risking the back book. When we bought Friends Life, it had about 13 billion of very conservatively invested annuities, and it was mainly in gilts and corporate bonds. So our excess origination was being applied to the back book. We haven't quite finished that, but we're a long way down that path now to move to a more optimized balance sheet overall. It's a long way of saying that our origination capability within the real asset world, can easily support 4 billion of production, based on our asset allocation choices and more. So 4 billion, roughly where we'll hit this year. We might be able to push that up a little bit further as we seek to grow the business in due course.
I think the important point, and you may have seen it come out about a month ago. Obviously, we did the first tranche on our own pension plan, and that was 1.5 or 1.7? 1.7. Now, that's obviously a decision the trustees make, but that is a fairly large block. So, I think one should expect that there's a sustainable flow. I think you'll also see this afternoon, and whilst we've guided previously, Angela will give, criteria on how we think about, hurdle rates with respect to IRR, and also how we think about the cash flow signature in terms of, cash actually coming back from BPA type transactions. So stay tuned. You're going to get more of that this afternoon.
Any final questions?
Yeah, Andrew.
Andrew.
A quick one. You gave, I think, your ambition on UK Life and the savings and investment business to be a 9.5% return on capital. Presumably, the savings and investment business is actually a very capital light business. So what's the return on capital target for the UK Life? And is that actually above your cost of capital hurdle? Because I suspect it's probably 7 or 8%.
I mean, we've kept it together because it is all run together currently. Aviva Investors within that, you're right, has a materially higher return on capital, as you might expect for an asset management business. We've not established a separate target. The returns within UK Life, of course, are two components. There's the return on new business, where we're hitting kind of low teens on average across the board. That doesn't always manifest itself in return on capital in any particular year, but across the board, that's the level of return that we've got. On the back book, that's a significant part of that return. Angela will go through, how that capital generation turns into cash flow during the course of the period. But we do hit, we are making a healthy return on capital within that, but it could be better. And if we can seek, take actions, expense efficiency or other actions to improve that in due course.
Okay. Thanks very much, everyone. We'll take a break there. We will have a lunch break now, and we'll open the doors and look to be starting again around 1:15 p.m. Thank you.